Hi, I'm Dr. John McCallig. I'm an assistant professor of accountancy at University College Dublin. I published a book on introductory financial accounting using IFRS that you can download at the link below. This playlist of videos explains all the important concepts and techniques that are in the book and that you will need to prepare basic financial statements. I've included a link to the playlist of videos below as well. Please remember to like the video and subscribe to the channel if you found this content helpful. This video is about accounting for payments in advance, payments from customers. When a business receives cash at the start of a contract, without having actually done any work on the contract, they must create what's called a contract liability. In general, contract liabilities represent an entity's obligation to transfer goods or services to a customer for which the entity has received consideration, or the amount could be due from the customer at the start of the contract. So let's look at a quick example of this. A customer may pay €80 in advance for a 2-year license for antivirus software. In this case, the business cannot recognize the revenue from that license until they've provided the service. So the customer pays the €80. We debit the bank because the money's coming into the bank, €80. We credit contract liability. So we create a liability account, and that liability represents our obligation to provide the service to the customer. At the end of the first year, when 1 year of service has been provided, the business can recognize 1 year's revenue and reduce the contract liability. So at the end of the first year, they can debit contract liabilities to reduce it by 40 because it was a credit to start with, and they can credit revenue, so release half of the payment into revenue when they have provided the service.